As you probably already know, a lot of beginner traders are losing money, and most beginner traders don't know the right places to buy. If you don't have a good entry, your trade is flawed from the beginning. Now, it doesn't matter if you're trading futures, Forex, cryptocurrency, or you're trading stock. In this episode, I'm going to share with you the universal language of the financial markets. I'm going to show you the very clear buy and sell signals that exist on all candlestick charts. Now, if you're not currently seeing them, it's just because your eye hasn't yet been trained to recognize these patterns. But that is about to change right now. So let's go ahead and jump into this deep dive of knowing the right places to buy. Let's start high level. We're looking at a 5-minute candlestick chart. That means each one of these candlesticks represents 5 minutes of time. As you may already know from watching some of my other episodes, which have been deep dives into technical analysis and how to read candlestick charts, the shape of these candles communicate market sentiment. And when we have multiple candles together, they create chart patterns. These chart patterns become easily recognizable buy and sell signals. This is a language of the financial markets. Again, it doesn't matter if you're trading Forex, cryptocurrency, futures, or you're trading stock. This is a universal language because all financial instruments can offer candlestick charts. So when you're looking at these charts, when I look at this right here, I'm seeing very clear buy and sell signals. And that's what I want you to be able to understand by the end of this episode. So high level, we have the price, which is clearly moving higher, right? And then at this certain point, it rolls over. So as a beginner trader, you may look at this and think, gosh, all right, well, clearly in hindsight, I should have bought maybe here or here, but it's always easy to say that in hindsight because in real time, when we're looking at a chart, we're seeing the candles forming one candle at a time. And now we have to make a prediction. Gosh, is this really going to get back up to this, 63, 64 level, or is this going to come back down to 56? And for a beginner trader, it feels like a guess. You're looking at it and you're like, I don't know. And I remember exactly what that was like. In fact, I remember a time where I'd been trading for probably almost a year, and I sat down and I looked at my charts and I was like, I don't see anything. I feel like I'm blind. Like I don't see any buy or sell signals. I think I was having a moment where I just was feeling really overwhelmed, and maybe I was looking at a really bad chart, which is probably part of the problem, but I just wasn't seeing anything. So let's back out of the chart for a moment and jump onto the whiteboard. And what I want to do is just sort of communicate high level what we're trying to achieve. So if we've got something, if we've got the price, which is moving up, and I'm going to just do this as a dotted line here. As it's moving up, we know that these always sort of go in waves. You have a wave up and then you have a pullback and another wave up. And the reason it's like that is because during this first wave, you have sort of the first round of buyers who are coming in. And then up in this area, you have your first round of profit taking. There are people who are like, all right, I'm going to lock up some profit, take some money out. And that creates a little bit of selling pressure. And then a new round of buyers come in. And this second round of buyers, essentially, they're looking at a stock or whatever it is. It could be a Forex pair or a commodity. Doesn't matter. They're looking at the price and they're like, this thing has made a big move, which therefore makes me interested. Now, something that is important to understand is that what creates sustained momentum is typically a catalyst. So having some type of news driving the move is really important. So if you're trading Forex, it could be economic news, unemployment, things like that, which can move currencies. If you're trading stocks, then you're looking at something like quarterly earnings that have just come out, news of a new contract, maybe FDA approvals, clinical trials, things like that. A true catalyst, because the catalyst is why people bought down here in the first place. They got in because there was news. That's why they bought. Right? And now naturally there's going to be some people who take some profit. They're like, all right, I made enough money on this, so I'm going to sell a little here, sell a little here. They take a little profit. And then there's a whole new round of buyers that sit down and see, holy smokes, this thing is up. Let's just say it's, 10% on the day just through this area. So at this point, you can't see any of that. None of this has happened yet. All right. So you just see, well, this thing is up 10% on the day and it's pulling back. So now the question is, where do I buy? Is this going to go higher or is it going to go lower? How can I make an educated guess as to which way it's going to go? So the way to do this is to use the candlestick charts to begin to draw out areas of potential support. The closer you can buy to a level of support, the lower your risk will be. Now, if I jump back on the whiteboard, something that I'll show you here, which I always have found very interesting, is that most financial instruments trade with a lot of respect to half dollars and whole dollars. So I'm just going to draw out, these are going to be resistance lines. Initially, they'll be resistance lines. So we're going to look at, let's just say we've got a news event here. News comes out at 8 a.m., 8 a.m. Eastern. And it could be any news. It doesn't matter, but news comes out and the initial response is that, boom, there's a wave of buying. So we have our first green candle that forms as news comes out. What's very common is that when the news first comes out, there's a huge pop. So early traders jump in really quickly and the stock, if it's a stock that you're looking at, the chart will have this blast off kind of move. And then what typically happens is we come into an area of resistance. Now, when a stock or whatever it is moving up, if it doesn't have obvious resistance on the daily chart, the resistance is going to come in around the half dollar or the whole dollar. So when we're looking at a daily chart, when I see something hit my scanner and it's moving up, when I'm looking at the daily chart, the thing that I'm checking generally is the position of the 200 exponential moving average. Now, on a recent IPO like Reddit, we don't have a 200 moving average yet because there have not yet been 200 periods of price action. So if we don't have 200 periods of price action, there's not going to be a 200 moving average. But if we look at, let's see, we had one today. We can look at LIXT. LIXT. This is a stock that had news this morning, and you could see it did make a little bit of a move. But pre-market, as it started moving, pre-market, I was like, well, we have an issue here, which is the 200 moving average right here at about $3.26. So pre-market, it moved up, and then at the open, it opened up here above the 200. And now look, it's coming back down to this level. So it's now finding support at around the 200 because it's above it. If you're below it, you're going to have resistance. If you're above it, you're going to find support. So this is a very well-respected level of support and resistance. So if we had something like that on the daily chart as the price is moving up, then I would say, oh, we've got to take a look at our daily chart to look for potential areas of resistance. And the most common is the 200. And you could see this is an example where the price came right up to the 200 and then it faded off that level. So once you recognize how common it is for the price to hit the 200 and fade, you're going to look at the position of the 200 exponential moving average pretty much any time before you take a trade. You're going to say, what's the position of the 200? Because if the 200 is really close, then this isn't something that I'm going to be able to trade here. So look at this. The 200 is at $2. So we know that that's going to be upside resistance if it comes up to that level. Okay, so given that we can initially do some due diligence by looking at the daily chart, the next step is by actually looking at the intraday candlestick chart. So this is going to be, it could be a 5-minute chart, it could be a 1-minute chart, it could even be a 10-second chart. But what I know is that if there's not a daily resistance level that's obvious, such as the 200 moving average, the next levels of resistance will be at half dollars and whole dollars. So for instance, this could be 6, this could be 650, this could be 7, this could be 750. That would be very common. And then what we see is as the price squeezes up to this level of 650, it's going to pull back for just a moment. It's going to pull back for a moment. And then what we want to see is the squeeze through this level. So this right here is beginning to represent the place to be a buyer, right in there. Now, if you were a buyer as this was squeezing up, the problem is where's support? I would say that support was the low of the last pullback, which is down here. Support would be back where it came from. So that's not going to work. Now, after 2 green candles in a row and a couple of red candles, I would say that this is starting to show support right around here at the bottom of this pullback. This is the area to be watching for an entry. The way I do it is I get really zoomed in on this area right here and what the price is doing. So let's say, for example, this is 650 on the offer, 650 up here, and down here, let's just say it's, 630. So what I'm going to watch is as we come down to 630, are there buyers at 630? Because if there are, they're going to be forming a level of support, those big buy orders. If I see big buy orders, and then I begin to see orders actually passing through the tape. Orders passing through the tape means I see it on the actual time and sales. I'll show you what that looks like. So I've got my small account platform right here. So I hadn't taken any trades in the small account yet today, so I'll just show you this. Okay, so let's pull up a stock, CZOO. This one's moving a little bit. So this is the tape. These are all the orders going through the time and sales, right? So you see all those orders going through. Some are red, some are green. The ones that are green are taking place at the ask price. The ones that are red take place at the bid, and the ones that are white are in between the spread. So as I'm watching a stock, I'm going to watch it pull back down towards a level of what I think could be support. Now, this is actually an interesting example right here, just as it turns out, because we had, this is almost perfect because look at this. See how it had resistance at $8? We came up to 8 once, resistance. Came up again, resistance. Came up a third time, we break through 8. What's the next target? 850. It goes right to 850 where it pulls back for a moment. Then it pushes higher up to 9. Next level of resistance at the whole dollar. This one's a little bit more expensive, so it's showing more respect at whole dollars, and it was able to get through the half dollar pretty quickly. But this is very common. So once you learn to recognize this, it would help you better understand why this could be a strong entry right down here to anticipate the break through this resistance level. Because we know if we break that resistance level, our next target is a squeeze up to the next half dollar and potentially whole dollar if the stock is really strong. So now we're looking for a move up towards 7. Now again, it wouldn't be uncommon if we pull back around 7 for a moment, and then that gives us the opportunity to establish a new level of risk at the low of this pullback, and then we get back in for the next leg up. Next leg up right here. So sometimes they'll break through if they're really strong. It's possible. Not as common though. So the entry that I want to focus on, where to buy, is during these little pullbacks. Because what's happening, the psychology of this pullback, you think about what other traders are thinking in that moment. So some traders were in earlier, and we had this huge squeeze, and they're like, I'm going to take some profit off the table. I'm going to press the sell button. So some traders start pressing the sell button. When they start pressing the sell button, orders start to go through on the tape in red. So we'll see we would see a burst of orders going through here in red. Those are sell orders. People are selling. Now, when other traders see traders are selling, they sort of feed off of that. They're like, ooh, people are selling. They don't like this right now. I'm going to sell too. And so you get this momentary pullback, this momentary dip. However, two things will happen. The first is that the selling continues and we don't see any buyers step in. So this will happen if usually there's not a really strong catalyst behind the move, because buyers who are watching the stock are like, okay, I see it's up, but why is it up? I don't quite trust it. So if they don't trust it, they're not going to press the buy button. They're not going to come in and become bid support. So there's no support. And then sellers keep selling and selling and selling until you have what we would call a round trip, where the price went up and then came all the way back down. That's not uncommon. It can happen if there's no real fundamental news to support the move. So if we have fundamental news, if we have a true catalyst and it's strong, we have a higher likelihood that we're going to see continuation higher. Now, it's not a guarantee because, of course, there are times where you have really great news and the price will go up a little bit, but then it rolls over. But the probability is higher that the trend will continue if you have a strong headline that's supporting the move. So then what happens is you get the red, you get the pullback, a couple of red candles, and then you start to see the green on the tape. The buyers step in. And as I said, when one buyer steps in, a few more buyers step in, all of a sudden you start seeing green on the tape. Now sentiment has shifted. So you could almost look at this as a sort of mini sentiment meter. What is the sentiment? I mean, in these moments right here, the sentiment is red. People are selling. They're like, nah, I don't like it anymore. People are choosing to sell it, right? But then the sentiment shifts very quickly. And now people are like, I want to buy it. I want to buy it. I want to buy it. No, I want to sell it. I want to sell it. I want to sell it. I actually want to buy it. I want to buy it. I want to buy it. So keeping a very tight gauge on what is current sentiment. Are people wanting to buy this or are people wanting to sell this? And I want to buy when other people are buying. Now, this is the exact opposite of what someone like Warren Buffett would say. He says, buy when others are fearful and sell when others are greedy. That is a value investing concept. The concept of value investing and where to buy a strong stock or currency or futures commodity is that you want to buy when everyone else is selling because there's such a strong imbalance. Everyone's like really bearish. They don't like it. They don't like it. And that's the time where you can have a pricing disconnect where the price is actually lower than the true value because people have almost oversold it due to emotion, because emotion creates the volatility in the market. So as a value investor, you want to buy things that are undervalued. And the way you do that is by buying something that everyone else is selling. You're like, no one else wants this. I'm going to buy it up. Now, look, there was a period where everyone wanted, what did they call them? Beanie Babies, right? Everyone wanted them. They were buying them, buying them, buying. It was a craze. And then that kind of rolled over. And then there was a period where no one wanted them. But did Warren Buffett go in and buy all the Beanie Babies? No, because just because no one wants it doesn't mean by default you actually should buy it. You need to have more criteria. So on an intraday level, I actually want to buy when I'm seeing other people are interested. And the reason is we profit from volatility. And so that means we profit from the emotions that are present in the market, the emotions that other traders are experiencing. So if all the traders are pressing the sell button, I want to be careful because obviously the price is going to be declining and it may not bounce back up. As soon as I start to see that shift in momentum, that's where I want to get in. Picture yourself at the beach and picture the tide rolling in, and rolling out. And imagine this, imagine that you'll make a lot of money if you can be the first to predict the moment the tide changes. Now, this can be very tricky if you've ever been to the ocean, and probably most of you have, right? So you see the tides rolling out. But even when it's rolling out, there's a wave that comes in and then it pulls back. And it comes in and then it pulls back a little more. And it comes in, it pulls back a little bit more. So the tide's coming out. And then all of a sudden you have this period where you have this moment of slack tide. Now, with the tide, it's more measured because it's going to come back. But with trading, it's not measured. But the moment it starts to roll back forward, that's the place to be a buyer. So as a trader, I often think of this in a similar way as kind of the ocean, that we're riding these waves. And sometimes there'll be a big wave. And then sometimes there'll be a little bit of a pullback. And then we want to get on the next wave up. So the trader who can predict and be in sort of as early as possible down here will make the most money. Now, as you have something that's stair-stepping down, I would say this is weakness. It's going lower. I'm not a buyer. The moment it fails to make another step down and begins to curl, that right there is the indicator that something different is happening. So with the price moving up, we know as the price is moving up, you're going to have these waves and pullbacks. So again, I'm looking at this as kind of that stair-stepping pattern. Stair-stepping pattern moving up, more or less, right? So the second we have a move where the price sort of comes up and then starts to sort of decline, that's when you're pulling away. Instead of stepping up, you're starting to drop back down. I'll draw it out a little bit lower. So the way this would look is all of a sudden right here, you're supposed to come up and it kind of goes like this, right? And then it starts to step down. So now this is where we're seeing that divergence. In real time, it's easy to see this when you're looking at the tape. So when you're watching the tape and you're seeing all those orders in green like we're seeing right now, we're seeing the price on this, just as this real-time example, coming back up to $9, right? So we know right now in these moments, people are like, I want to buy it, I want to buy it. What we also know is that it's likely going to have resistance at 9, the same way it had resistance at 8 right here and right here. While it may be able to break through it, and it would be a strong achievement for the stock if it can, it's also possible that a lot of people will place sell orders around that $0.50 and whole dollar, both to take profit and potentially to short. So resistance, look at how firm that resistance is at 9. Did you see how the sellers were stacked up there at 9? And now look at that drop all the way back down to 8.45. So you could see how buying right up there would have been a risky entry. So let's talk about support. What I like to do is I like to draw these ascending support lines where I connect the lows of recent pullbacks. The most valid lines will be the ones that touch the price in the most places. When you start to see a level like this is where I would say that anywhere near the support level would be a safer place to buy than up against the resistance level. So if I can buy down here off of 845, 850, then I'm in with a very tight max loss. I would set my max loss just below this blue line. As long as we hold it, I'm going to keep holding. But if we break it, then I'm going to get out. So the thing here is that on these little pullbacks, we have a dip down, we see a little green on the tape. I like to take a starter down here. I don't want to wait till it's all the way at the top. I want to take a starter down at the bottom, down in this area. Because if I take a starter near support, I'm managing my risk better because my max loss is very close. So then the loss will be small. Now, if it creeps up, I can always add to the position if it moves higher. So if we break over 9, what'll likely happen is we'll come back and we'll retest that resistance level. If we can hold above it, then I take another trade right there for the next leg up. And that's where we start stair-stepping up, right? We start stair-stepping up and moving higher. And that's exactly what we want to see. And that is what we see when we have a stock that has strong momentum. Now, one problem with this particular stock today is that it doesn't have a news catalyst. There's no fresh news. Now, it may go higher just because it's already up quite a bit. There's a lack of other stocks to trade and people are focusing on it. But I think at a certain point, buyers are going to get nervous adding too high because they're just going to feel like, this thing it's just too extended. I can't bring myself to buy it up 100% with no news. And short sellers are going to look at this and start to think, you know what? I think this is an opportunity to short it coming back down because it has no reason to be up this high. So when it comes to knowing the right place to buy, from the perspective of a candlestick chart, where we want to be buying is on a pullback. So first we have, let's just say a big green candle like this, a red candle, another green candle, and then we have the first red candle and a second red candle. These red candles help us establish that we're currently on a pullback. I have a rule of thumb that if a stock pulls back more than 50% of its initial move here, I'm no longer interested. So 50% is the most it can pull back. I'd prefer that it only pull back to about the 75%. It only pull back like about 25% here. So it's still holding 75% of the move up. This is preferable. So then what I'm looking for is on the actual level 2, which is the depth of the market. That's what we see by actually pulling up our platform. What I want to see are stacks of buyers. Now, right now, this is beginning to break this level, which again is not surprising considering there's no news. But see how there's a buyer right down there of 12,500 shares at 815. So now you're seeing some buying support. Some people are selling into it, but it's not breaking yet. That starts to establish that, okay, there is a buyer that is stepping up on this. Now, in this particular example, the candlestick chart doesn't really line up very well, so it's not a trade I would take. But if there was a perfect pattern on the chart and we saw that buyer, that 15,000 share buyer or whatever it is down here, then that's starting to show we've got some support. So once I see the buyer coming in, then the next thing I'm looking for is on the time and sales, the time and sales window, I want to see orders going through in green. This is what's telling me that the wave, the tide of sentiment is beginning to shift. So we'll start to see some green orders going through. So maybe the first one is, sort of at this lower price here. And then what we want to see is that the price starts to move higher. But as soon as I see those first green orders going through, that's where I'm taking usually a starter position. And my stop is around the level of this buyer. And I always, for myself, from a risk management perspective, I want to risk 100 to make at least 200 as a general rule of thumb. Now, the reality is I am eternally optimistic. So if I think a stock has the potential to give me $200 of profit, that's optimistic. I probably am only going to make 100. So that's fine. But I factor that in knowing that I'm overly optimistic. So when the trade is said and done, usually my profit to loss ratio is closer to 1-to-1. Okay, so if I'm going to risk 1,000, it's because I believe I have the potential to make 2,000 on the move back up. And although I may only lock up 1,000 in total profit with a 1-to-1 ratio, that would still leave me with being profitable at 50% accuracy. So then as we move higher and we move higher, this is where I would start to take profit off the table. So when to sell, this is locking up profit as the price is moving higher. It's about being disciplined, taking your profit off the table, not overstaying your welcome, and then expecting at some point, we're going to see another pullback. One of the ways that I can try to keep myself in the position as long as possible is by waiting to sell until I start seeing orders in red coming through the tape. Now, the fact is, if I wait to see the first indicators here, then I'll sort of be joining the crowd of sellers and I might not get as good of a price. But on the other hand, it keeps me in the position as long as possible. And I want to stay in the position as long as possible because if we have something that is strong, then who knows? This could end up making a move, here from 6 to 650 to 7 to 750, with 10,000 shares, this could be a $10,000 winner. This could be a huge trade. So I want to try to hold as long as possible. The worst thing you can do is have a great entry and then sell like right here. And I've done that many times. I've had a terrific entry and then I sell when I'm up like 10 cents. And so you have to ask yourself, if you know the right place to buy, you're buying near support, you've got a very well understood level of risk that you're taking, why would you sell too soon? Why would you bail out? Typically, what causes this behavior is fear. It's the fear of losing this winner. So when you're in a trade and it's up 5 cents a share, 10 cents a share, it's not a big winner, but it is a winner. And if you sell right then and there, you lock it up. So what drives the action is the fear of losing this tiny winner. You don't want to have it turn into a loser. So you're like, you know what? I'm just gonna press the sell button. You press the sell button and then you're out of the trade. And then you watch it do exactly what you thought it was gonna do. It goes a lot higher and you're like, oh my gosh. So the worst thing you then could do is add back at the top of this move, buy back right up here. You give into FOMO and you now get back in up here. And then you stop out down here as it dips down, right at support where the more seasoned traders like me are going to be getting in. And that's how easily you could be on the wrong side of a trade when you give into FOMO, when you give into emotion. It's fear of missing out, but it's also just fear in general. Now, fear also has the effect of making losses bigger, because when you're in a losing trade, rather than just cut the loss and move on, we tend to hold and hope it'll turn around. And the reason we do this is because until you press the sell button, there's always the hope that it could reverse and go back up, because it doesn't feel good to lose. Now, this is something that is really hard because trading requires a lot of losing. You have to be a really good loser to be a good trader. The fact is, I lose all the time. And even after all these years, I'm going to be honest, it's not easy. It's still painful. It's still frustrating. It's still upsetting. If I have a whole week where, I'm not able to get in the zone, I feel like I just have loser after loser. Even if I'm not losing a lot of money, it's just like, how many times can you sit down to play Monopoly and lose before you're going to flip the game board? You know what I mean? You start to just lose your cool. It's like, oh my gosh, am I losing again today? This is ridiculous. right? So now emotions coming in, you're getting frustrated. Now you're more likely to get stubborn and kind of try to like, I refuse to sell. It's going down, but I will not sell. And now things can unravel pretty quickly. So it's really important to recognize that really good trading habits, it's not just about knowing the right place to buy. It's also making sure that you follow the plan of the trade. So let's talk high level for a second about what a trading plan should look like. A trading plan, number one, needs to dictate the following. All right, so we're going to write trading plan. So a trading plan, number one, needs to dictate your strategy. Now, for me, my strategy is trend trading. So I'm a trend trader, which is also called a MOMO trader, a momentum trader. So I'm trading the trend, I'm trading momentum. All right. So then the sub of that is a time of day. What time of day are you trading? So this is going to be based on your time zone. So if you're in, and look, it depending on what you trade. If you trade cryptocurrency, it's open 24 hours a day. If you're trading Forex, you're going to trade during the windows where the Forex pairs are trading, depending on when the banks are open for that country. So you could choose really to trade during whatever time you want that's convenient for your work schedule and everything else. I choose to trade, I'm on Eastern Standard Time, and I choose to trade from 7 a.m. Eastern to about 11 a.m. at the latest at this point, unless it's a really strong day in the market. B, you got to talk about the price stock you're going to focus on, or commodity, or whatever the case is. For me, it's between $1 and $20, lower price. Number C, you have to talk about the actual patterns that you're going to trade, right? So what's your go-to setup? And this for me is where we're talking about first and second pullback. So we're focusing on the first and second pullback, buying those dips. And then we talk about, let's see, D, stock specifics. So stock details. So this would be things like news catalyst, the float, right? Daily chart. And we start to get into the details. Once you dial all of this in, and let's not forget, of course, a big item is your risk management practice. So how are you going to manage your risk, right? So documenting all of that is what creates the trading plan. And you're going to have rules in that plan. The way I think of the trading rules is I think of them kind of as training wheels. And the reason I think of it like that is because as a beginner trader, just like someone riding a bicycle as a beginner, training wheels are helpful. They help you build confidence. They help you stay in control. They help keep you safe. So the type of training wheels that I would put on your account, if you were a beginner trader, I would say we've got to have training wheels of your maximum position size, you know, how much leverage you're going to use, what your risk is, because as a beginner, you're going to make mistakes, right? So we don't want to set you up for a disaster by giving you too much free range at the very beginning of your learning curve. That would be reckless. It's not a good idea. But a lot of people do it. And they do it because the brokers are happy to give you the leverage. They're happy to let you trade with tons of borrowed money because more trading for them means more money for them. So they have their interest in mind, right? Not necessarily your interest. You want to be the small percentage of traders who is consistently successful. That's, of course, the idea. That's the goal. So that means you've got to approach it and think about it differently from what most people are doing. So you've got to document your trading plan. You have to have the discipline to follow all of the rules. And you've got to keep your training wheels on relatively tight when you're getting started. Now, what I'll do for this episode, if you click at the top of the comments, pinned to the top comment, and at the top of the description, I'll put a link where you can download my small account strategy PDF. This is a document that you can print out, and it has essentially all of this, except not in messy handwriting, but it has more. It details the ins and outs of my strategy as I trade it right now. And you could apply that strategy to really any market that you want, although I'm choosing to apply it to the stock market, which is where I have found a lot of success. So now what I want to do is I want to show you a live trade. This is a trade that I took in my small account, and this is a recording. So I'll pause this for 1 second. So we'll get oriented. Okay, so this account currently has, when I was recording this video, $2,314 in it. That was my equity, so pretty small account. This is the stock that I'm looking at. It is up currently 21% on the day. It's just been hitting my scanners, as you can see right here, as it popped up to about $7. And what I noticed was it popped up and then it pulled back. It came up again to 7, it pulled back. It came up again to 7, it pulled back. It came up again to 7. And what I'm looking is to see if it can hold over 7. So I want to see it break 7. And if it can hold over 7 on this trade, I'm going to buy with a stop right at 7. So I'm using $7 as my support and resistance level. So in this case, watch, I just bought 1,000 shares at $7.23. We now have $7.50 on the offer, $7.49. No, look at that. First of all, let's just back this up for 10 seconds. Watch how this respects half dollars and whole dollars. Resistance is $7.50. Next resistance is at $8. Next resistance is at $8.50. Next resistance is at $9. I put the order out to take a little profit. I sell a few shares at $8.36, a few more shares there at something, whatever price that was. Now you've got on the offer $7.93, and I'm unwinding a little bit more. This is a setup where we got a big breakout. The price broke through resistance. So what was resistance? Resistance was at $7. So in this case, then there's different ways you can trade this. But in this particular case, what I decided to do was, because I was a little bit concerned about the fact that, I'll just erase this for a second. So because I was a little bit concerned about the fact that we'd already come up to 7 once and then pulled back and then came up a second time and then kind of pulled back as we were coming back up this third time, right? So we came up once and then we sort of pulled back down. And then we came up a second time and then we kind of pulled back down. I was like, I don't want to get in right here and have it fade back down, right? That's not going to work. So I said, I want to see if it can prove that it can break over this level. If it can break through this resistance at 7, then I'm interested. Because then I'm buying here and my max loss is right here, right underneath the previous resistance, which means I'm in at 725 approximately with 1,000 shares, and my max loss is about 698. So 698. So that means I'm risking approximately $250 on the trade. I don't mind taking $250 of risk to make $672. That, as it turns out in this case, is a great profit to loss ratio. Now, realistically, my target was not that it was going to go all the way up here, boom, to $8 or $9. It was just initially, can this get up to $7.50 and then to $8? And it just ended up making a really nice move, which sometimes happens. But most important is that you have a good entry. When you have a good entry, you can manage your risk. So I'm watching very closely these levels of resistance, and I want to do one of two things. I either want to wait and let it prove that it can hold over it, or I want to buy that pullback. Now, let me show you an example of the pullback. Okay, so GXAI has just hit my scanners, and it's up 17%. So this stock is popping up, it's moving up, and what we can see is that it hit a high of about $6.65 and is now pulling back. This is forming that micro pullback. So what I end up doing is I press the order to see how many shares I can buy, and as soon as I see this green on the tape right here, I'm in. All right, I already know that we had this pullback, so we already had the red, and as soon as I see the green coming back in, I know that I want to buy. Now, something that I could tell you about this stock is that it is just past 8:30, the bottom of the hour. News has just come out. The stock is moving. It's got a micro pullback, the beginning of the move, and I want to jump in. Let's watch and see what happens. So on this one, I'm in at $6.48. There's $6.69. There's $6.70 on the offer. $6.25, $6.70, $6.85. There's 7. Now we've got $7.17 on the offer. $7.70 on the offer. I took a little off the table there, sold 3/4 of my position at about $7.50, $7.25 actually. Currently up $657 on a 1,000 share position. Again, max risk on this trade is about $250. Getting $600 of profit is a great trade. So this is the profit loss ratio that I'm aiming for. What we're seeing right now, again, is a 10-second micro pullback. So see right in this area, watch as we get, there's green. See the green on the tape? And we pop up to $7.75, $7.85, $7.96, up to $8. We break through 8, we go all the way to $8.50. Now, Should I have gotten in right there? I should have. I should have punched it for another trade right there. There was the first pullback right here, and then there was the second pullback right here. We had the dip, and then once that green came back in, so this is riding those waves. So we want to let the tide go out, and then as soon as we see it coming back in, boom. And then let it go out, and then as soon as we see it coming back in, boom. And this is where I have found so much success. It's by being able to sort of predict where those moments are going to shift, where we go from selling to buying and then shifting back from buying to selling. Now, it's something that takes time. It takes time to get good at. It takes time to practice. You've got to not only have a really good understanding of the chart patterns, but you also have to be able, as you can see, to read the order flow. The order flow is sort of the zoomed in view of the market. Now, order flow is not showing you a chart, but it's showing you in real time the current sentiment. So right now you've got a lot of buying, and this gave us another move higher, right? So now we've got 3 legs up, 1, 2, and then this was the third one for that next push up towards $9. So this is the type of instrument I want to be trading. It's now up 60%. We've had days where we've seen stocks go up over 500%, over 1,000% because they have news. It starts squeezing up and it just goes higher and higher and higher. This is especially true with lower price companies, small cap stocks, because for these companies, good news can change the course of the company entirely. All of a sudden, it makes the company a buyout target from one of these bigger companies. And then traders can get really excited about it. Okay, so now we've got 2 examples of buying these, either a pullback in this case here, or in the second case, buying as we get the break of resistance. Right, so these are the levels that you want to be watching. Watch your half dollars, watch your whole dollars, watch in these areas, and watch your pullbacks. So you're going to see things squeezing up. Just because it's squeezing up doesn't mean it makes sense to punch it just here or punch it here. You want to wait for that little bit of a pullback. Now, in this case, this was a little bit of a bigger pullback than we would like. We would probably prefer something that's a little bit more like this. And one other thing that it's important for you to understand is the concept of the volume profile. So we'll just have it push through here. That'll look a little bit better. So this is called a cup, and this is called a handle right there. So this again is just a better way of understanding potential entries. When you have the price come up, it sells off and then comes back up. This is usually a double top, and double tops reject. They don't usually work. So that forms the cup, and then you need the handle. And once you have a handle, your support is at the low of the pullback. But what you can always look at, this is like understanding constellations, but what you can always look at is what is the low of the last pullback? What is support? What is resistance? Because these are the levels that you're always trading around. And the closer you can buy to support, the better you'll do. But you don't want to buy until you see that the trend is beginning to shift. And the way I see the trend is beginning to shift is by looking at the tape, looking at the level 2. I understand that for some traders, this is going to feel overwhelming because you're like, oh my God, this is a whole new language. It is. You're learning a language. It's the language of the financial markets. But here's the cool thing. If you immerse yourself in communities that are speaking this language, just like trying to learn French or Italian or anything, any other language, it's going to come more naturally. But you have to do the work. You've got to commit to it. You've got to immerse yourself in those communities. You've got to read the language. You've got to just start studying. And you've got to push through those moments where you feel a bit frustrated, because there will be gaps that will get filled in with time. One of the things that I've noticed about pretty much every beginner trader is that your accuracy is poor. A lot of beginner traders come in kind of overconfident. They don't know what they don't know. They take too much risk. They make a lot of mistakes. They lose money. And then there's this humbling point of like realizing how much there is to learn, really sort of settling in and being like, I want to learn this thing. I want to learn as much as there is to know about it, which is probably why you're watching this episode. So thank you for doing that. I hope, by the way, you hit the thumbs up and subscribe to the channel. And then you get this period where you start to see rewards from all of that hard work. You're starting to really look at these patterns in real time and be like, yes, I think this is going to go higher. And you watch, as you kind of get this pullback, and it's like, right, I think right now we're seeing the micro pullback right here at $7.60. This is the place that I have to be a buyer. So I want to take a moment to walk you through what I view as the steps to becoming a day trader. And these steps would be pretty much the same for being a trader of any type. If you're going to be a swing trader or just a short-term investor, the steps would be the same. If you're going to trade Forex, futures, cryptocurrency, the steps are more or less the same. So the first step is to learn the foundational concepts. And when I'm talking about foundational concepts, I'm talking about these 10 specific things that you really need to know in order to find success as a trader. I sort of talk about the minimal viable product, MVP. MVP, I talk about this in my book that I wrote, How to Day Trade the Plain Truth, the minimal viable product for day one of trading in a simulator. So for day one of sim, look, you could get in a car and sit down with zero experience and probably figure it out. You could sit down in a simulator and start pressing some buttons and you could probably figure it out. But if you want to have a good experience to get ready for day one sim, the minimal viable level of information is the following. First, you need to know your terminology. And this is something that, although I have a glossary of all of the terms that you need to know and that I frequently use as an active trader, which you could reference in my book, the terminology is mostly going to be something you'll pick up along the way. So you're going to be picking it up just as you're going through the classes, watching episodes like this one right here on YouTube, and so on and so forth. So, yes, there are a lot of terms that we talk about. What's a doji? What's the market cap? What's a margin call? What's a reversal? What's scaling? Just these different terms related to trading. So these are important. So number one, you need to know the terminology. You need to know the lingo. And I really think the best way to pick it up is, of course, just to keep watching episodes like this, to read books on trading, and to immerse yourself in a community of traders, because that's where you're going to see other people talking the language and you're going to pick it up faster. Step number two, or item number two, you need to learn technical analysis. Technical analysis, this is what we're talking about right now, is charting, essentially. But to really understand technical analysis, you need to know the ins and outs of charts, and you need to know how to use different technical indicators. And you need to be really comfortable with being able to analyze different time frames. You want to be able to recognize when you have multi-time frame alignment and when you don't. Number three, you're going to need to get good at fundamental analysis. Now, as an active trader, the amount of fundamental analysis that we do is relatively limited, right? We're not reading at night all of the quarterly filings. We're not doing the level of due diligence that someone like a Warren Buffett would be doing before he's taking a position in a company and planning on holding it for months or years. But we do need to be able to understand some basic fundamentals of a company. And this helps us better interpret and understand the news. So when news comes out, we're able to understand how significant this news headline is. Number four, you're going to need to get really good at risk management. You need to also be able to understand the concept of successful red days, because red days will happen as a trader, and a successful red day is a red day where you don't lose your cool. You don't lose your emotional composure. Okay, you take a loss, but it's within your parameters that you've previously set for yourself. And that's the best you could do. A successful red day generally is going to be a small red day, but most importantly, it's a red day where you continue to follow your rules. Remember, it's so much easier to recover from small red days than from days where you have, things really go off the rails and you have a huge drawdown. That can take weeks to recover from. So I always look back on those days and I'm like, why didn't I just walk away here? If I'd walked away right there, that would have been a successful red day. So that's something that you really will get better at through making mistakes and experience. And even with all that experience, it'll still happen sometimes. You have what would be considered an unsuccessful red day, but getting really good at your risk management and understanding successful red days is paramount to your long-term success as a trader. Number five, you're going to need to get really good at stock selection. Now, stock selection specific for stock, currency selection, currency pairs for Forex traders, commodities for futures traders. But you need to get good at figuring out what's going to move. And the fact is, regardless of, we could just say asset selection, regardless of what you're going to be trading, what you're looking for is volatility, right? We're volatility traders. We want to be trading something that is moving higher. If something is going sideways, we don't make money. We don't make money by buying something at 5 and selling it at 5. We make zero money. We take risk and we don't get reward for it. There's no reward. We want to buy something at 5 and sell it at 7. And we'd love to do that in like 10 minutes. And you know what? In the stock market, that happens all the time. I see that happen almost on a daily basis. So you need to get really good at asset selection. This is also a form of risk management because the better you get at choosing the strongest assets, the more you're reducing your risk of unnecessary losses. Number 6, you're going to need to get really good at using trading platforms. So that means you know how to use the software, you know how to press the buy button, how to press the sell button, you know how to adjust all the settings. You become a master of the software that you're using. The software is an extension of your mind and body. You are able to use it to trade the markets. Number 7, you're going to need to get really good at order entry and using hotkeys. Order entry and hotkeys, this will streamline your ability to get in and out of positions. So you need to be able to master that. Number 8, you need to get really good at reading level 2 and reading the time in sales. Tape readers, level 2 reading, this is important for active trading. Not as important for longer term trading, swing trading, but definitely for day trading. Number 9, you're going to need to get your trading psychology dialed in. And this ties into successful red days, not giving into emotion, being able to recognize what your triggers are of where you're starting to become more emotionally fueled and potentially your triggers for an emotional hijack episode. And number 10, you need to get really good at position management, knowing when to scale in, when to scale out. So a lot of beginner traders will just take the approach of one entry and one exit, but they're not maximizing their profit by doing that. So more experienced traders will add to a position a little higher, a little lower, and then they'll scale out of position, trying to capture as much of the move as possible. So these are 10 of the, I would say, lessons that are certainly covered in depth in my Warrior Pro curriculum, but that you could learn on your own. It would probably take longer, but by just sort of reading books, watching episodes like this, and so on and so forth. So the 8 steps here to becoming a successful trader. Number 1, learning the foundational concepts. Number 2, sim trading. Number 3, evaluating your metrics and adjusting. So when you're trading in the simulator, you're going to be producing a lot of historical data, a lot of trading metrics. You want to evaluate those metrics and make adjustments based on your performance. Better for worse. Number 4, go live only once you've first proven profitability in the simulator, and go live with small share size. Start small at first because you have to begin the process of conditioning yourself to experiencing the emotions that come with trading with real money. Number 5, scale up slowly. You don't want to go in too deep too quickly. If you do that, you can get yourself into trouble. So scale up slowly. Again, this is part of the process of emotional conditioning. And then you're going to experience your first drawdown. When you experience your first drawdown, it's really scary because you've had some success. And now potentially you give it all back in one day of emotional hijack. And you're like, oh my goodness. So your first successful recovery is a huge milestone. And in your first successful recovery, what I want you to look at is the previous track record that you have. That's what's going to give you the confidence that, okay, you had this loss, but it's time to reset, go back to the drawing board, get focused, and then rebuild. Once you make your first successful recovery, recouping all of those losses, that's when it's time to scale up in a bigger way. So this is where sort of the rubber meets the road. The process of converting the general knowledge that you're picking up right now in this class into actual skill is done through practice. You've got to practice. And what I would encourage you to do is download my small account strategy PDF, print it out, put it on your wall, and then take screenshots when you see charts like this and print these out and put them on your wall. And mark up the areas of support and resistance. So be like, okay, we had resistance here, we had resistance here. This was the low. So notice the stair stepping up. It goes up, it comes back down, it holds this level, and then it moves higher. The more you recognize these patterns, the better you'll do. Traders are really doing something kind of incredible, which is we're dealing with pattern recognition. So we're seeing these patterns, but we get to the point where we see just this much of it, and we're now able to visualize everything else that's going to come next, right? So right now you see this and you might be like, I have no idea what's going to come next. But the more you practice, the more experience you gain, the better your intuition will get at being able to make a prediction of what's coming next. That's the cool thing about trading. And for me, even after more than a decade of trading experience, I still feel like I'm learning. I still feel like my own intuition is getting better. And I've been doing it for that long. So the sooner you start, I think the better. This is one of those things where it would have been great if you had started 5 years ago or 8 years ago or 10 years ago. The next best time to start is now. So I hope you just keep watching all of these episodes like this. I've got so many classes on strategy, a lot of free content that I put out on YouTube for the trading community. But of course, I've got my content that's part of my Warrior Pro curriculum over at Warrior Trading. So you're welcome to check it out. But in the meantime, I hope you hit that thumbs up. I hope you subscribe to the channel, and I'll see you for my next upload real soon.